Between 2017 and 2019, $25 billion were raised by ICOs, or people offering tokens to investors. And during that period, 3,000 different types of assets were offered to investors. And finally, $2.3 billion worth of value was traded last year alone on decentralized exchanges. Now, it's not that clear, but if you look at one of those exchanges, Ether Delta, they moved $1.4 billion with over 2,000 assets, run by one guy and one laptop. They were 24/7, and trading instantly settled and cleared. So if you compare that to something like the alternative investment markets in London, you see that it beats it across every dimension. So you have this organization from 1995, operational for ages, run by the London Stock Exchange. So they have great infrastructure with over 200 employees, and they get outgunned by one guy sitting in Brooklyn and his laptop. So what do we take away from this? Well, cryptocurrencies are a better way to trade value. The infrastructure they provide just makes it easier to trade. I think no one can debate that given the figures. Now, the second point I want to make is about regulation. So the skeptics are going to be talking about, yeah, fine, better way to trade, but one market with real standards and one that's a cesspit, and the cesspit's guaranteed to rip people off pretty hard. This is what the SEC had to say about it. I'm concerned that 30% of those that list are gone within a year, and that feels like a casino, and I believe investors will treat it as such. Harsh, fair, but harsh. And then finally, if you have low standards of regulation, you need high levels of scrutiny. The combination of low standards and low scrutiny makes it the worst market in the world. Fair points, except all these quotes are about the London Stock Exchange's alternative investment market. So this idea that regulation is a function of the asset you're trading is obviously not true. It's a function of the exchange you're trading on, right? And again, the skeptics amongst you are going to be like, okay, fine, but one's offering shares in a company and others offering tokens. And that is true because the statistics are pretty bleak. So 72% of listed assets lost money. In 30% of cases, investors lost 95% of their initial investment. Okay, fine, that's pretty dangerous. And finally, you had this asymmetry casino vibe where you had 39 assets that generated over 1,000% returns over several years, and that's just 1.4% of the total. And those points are really true, and they would be relevant if I wasn't still talking about the alternative investment markets in London. So the point I'm trying to make here is cryptocurrencies are no different from other assets fundamentally. The trading behavior, the volatility, the scams, these all appear on traditional exchanges that aren't regulated. So if the London Stock Exchange's alternative investment markets isn't getting it right, it's nothing to do with crypto. It's to do with regulatory oversight. Now, the third point I want to make is a bit simpler, and it's just about analog versus digital. I don't have much time, but if you want to scan this QR code and get a digital copy, that's cool. If you don't happen to catch it in time, it's not that relevant, so don't worry about it too much. And I'm on tight time, so. But if we look at snail mail versus something like email, snail mail kind of has end-to-end protection. If I don't want the NSA looking at my letter, I just duct tape the envelope, make it really hard to see through, and I send it on its way. And then if someone tampers with it, I kind of know. And this varies from email where you're leaving digital copies of the email everywhere, so it's difficult to track if someone has tampered with it. And then you also have the physical element. Whenever there's a physical element, now it's harder, right? If I wanted to scan every letter sent across the US, it would be difficult, whereas I could automate scanning everything that goes out of Gmail. And then the final point is around regulation. If you tamper with someone's mail, it's a federal offense, whereas it's a bit of a gray area when it comes to email. Now, if you asked an intelligence agency how they preferred you to communicate, they'd probably say email because it's just easier for them to do their thing. And I'm not agreeing with this. All I'm saying, if you had to pick one or the other, the digital is easier to regulate or over-regulate. And this applies to traditional media all the same. If you have physical DVDs and then they get pirated and distributed, this is all happening offline. You don't even know the data behind how many pirated copies exist. Whereas the digital equivalents, you can tag, you can use algorithms to search the web, see if it's been pirated. And historically, traditional media had to compete with pirated copies on cost and convenience. And I wasn't going to go to the store and pick up a DVD if I could, download it on Napster or Kazaa or whatever. And once technology evolved and regulation evolved, especially to compete on price and convenience, a good example is Apple with 99-cent downloads on iTunes, we saw a reduction in piracy. So if we look at physical literature like printed type, it's a subsect of traditional media, so it has the same thing. You have physical distribution is required. It's hard to compete on price. It's hard to compete on convenience. And most importantly, it's difficult to manage accessibility compared to a digital counterpart where it's easier to manage accessibility. So for example, if you guys go home and you refresh the presentation, or you can refresh the presentation right now that you scanned earlier, you'll notice that you can't access it anymore. Your access has been revoked. So it's pretty clear. Takeaway number 3, it's easier to regulate digital solutions than their analog counterparts. The caveat being in the medium to longer term as regulators adapt and evolve. So those are the 3 takeaways I wanted to share with you. So what did we learn? 1, cryptocurrencies allow for easier trading and issuance of value. Point number 2, they're not different to other traditional assets. All these differences that people cite are a function of regulatory governance. And then 3, theoretically, they're digital, so they should be easier to regulate than shares or bearer shares or anything like that. So if these are the conclusions, I think it's very easy to see what the killer use case is. We should use the technology to issue and trade value. And then we should use the benefits of the technology to make sure investor protection and regulatory oversight is improved. And that's kind of what we do at Jibrel. So we've partnered up with ADGM, which is the capital markets regulator in Abu Dhabi, and Evershed Sutherland, a leading law firm. And we put startup equity in token format. So we create digital shares. And these digital shares are offered through a website, and you can go to Jibrel.com and check out which startups we've tokenized. And this allows to capitalize on that ICO fundraising craze that happened, where accessibility was so easy, so companies were raising millions, billions of dollars in a matter of minutes. So that's one element we provide. And then the second element is, since these digital securities are represented in tokens, you can send them like sending an email. You just click, select a contact, write the share amount, and you've sent them. And obviously, because these are tokens, we can regulate them. So if you try to send them to someone in a different jurisdiction, it won't go through. And that's really good for the regulator, because since this is all built on blockchain, you can trace every transaction. You can intervene in every transaction. So we've quite demonstrated that this technology is probably how the future will run with regards to issuances of any sort of value. Now, we've started with our platform, and you'll be able to check it out if you go to Jibrel.com. But we want to work our way all the way to a full-on digital exchange where people will be able to buy and sell these equities amongst themselves with very little overhead and higher compliance. So that's all I have to share with you today. I hope it was a bit eye-opening on certain metrics. And if you take away anything, it's next time someone's like, yeah, cryptocurrencies are stupid. All anyone wants to do is, trade them. They have no use case. You can look them in the eye and be like, that is the use case. Because it's a better way to trade value. And we have a table here and a booth, so if you're around, come by and ask any questions. And thank you so much for your time.